Imagine waking up tomorrow morning and seeing gold prices suddenly exploding across every financial headline. Analysts on television are shocked, investors are rushing to buy, and markets across the world are reacting within seconds. But the real question is this: what actually causes gold to move like that? Is it just inflation, interest rates, or something much deeper? What if the real force behind major gold rallies is something most people rarely think about? Global conflict, rising geopolitical tension, and the quiet power struggle between nations. History shows that whenever the world becomes uncertain, whenever political tensions rise, whenever the possibility of war appears on the horizon, gold begins to move in ways that surprise even experienced investors. Today, on the Gold Report, we're diving into one of the most powerful and fascinating forces in financial markets: the relationship between war, geopolitics, and the price of gold. And once you understand how these forces work together, you may start seeing the gold market very differently. Before we go deeper, if you enjoy learning about gold, global markets, and the hidden forces shaping the financial world, make sure to like this video and subscribe to the Gold Report. Your support helps us continue bringing detailed market insights and helps more viewers discover this channel. Now let's continue with something many investors overlook. Gold is often called a safe haven asset. But what does that really mean? It means that when investors feel uncertain about the future, when political risks increase, and when financial systems begin to look fragile, they move their money into assets that have historically held value during crisis. And for thousands of years, gold has been one of the most trusted stores of value on Earth. Long before modern currencies existed, long before central banks and digital trading systems, civilizations across the world trusted gold as money. Empires collapsed, borders changed, currencies disappeared, but gold remained valuable. That long history is exactly why during moments of global uncertainty, investors return to gold again and again. Now think about geopolitics. Geopolitics simply means the way countries interact with each other politically, economically, and militarily. When relationships between nations become unstable, markets start reacting quickly. Investors watch closely for rising tensions between major powers, trade conflicts, sanctions, military conflicts, or even political instability in key regions. All of these events create uncertainty about the future of the global economy, and uncertainty is one of the strongest catalysts for rising gold prices. When geopolitical tension rises, investors begin to worry about many different risks at the same time. They worry about disruptions to trade, disruptions to energy supplies, financial sanctions, currency volatility, stock market instability, and sometimes even the possibility of larger conflicts. When all these fears appear together, capital begins moving toward assets that historically survive crisis, and gold is often at the top of that list. History provides many powerful examples of this relationship. During major global conflicts, gold prices often rise dramatically. When the world entered periods of uncertainty, such as the Cold War tensions, Middle East conflicts, or large geopolitical standoffs, gold repeatedly attracted global investment. Even when conflicts do not turn into full-scale wars, the uncertainty alone can move markets significantly. One important reason for this is that modern financial markets are extremely interconnected. News about geopolitical events spreads instantly across the world. Investors in New York, London, Tokyo, and Singapore react within seconds to developments happening thousands of miles away. When tensions escalate, large institutional investors begin adjusting their portfolios to reduce risk exposure. This often includes shifting capital from riskier assets like stocks into safer assets such as gold. Another powerful factor comes from central banks. Many people don't realize that central banks themselves are some of the largest buyers of gold in the world. When geopolitical tensions rise, central banks sometimes increase their gold reserves to reduce dependence on foreign currencies. Gold becomes a form of financial insurance for nations. Unlike currencies, gold cannot be printed. Unlike bonds, it does not rely on the credit of another country. It simply exists as a globally recognized store of value. This is especially important during periods when political alliances begin shifting, or when global financial systems appear unstable. If a country fears that sanctions or political pressure could affect its access to foreign currency reserves, increasing gold reserves becomes a strategic decision. Over the past decade, we have seen several central banks increasing their gold purchases as geopolitical uncertainty grows. Another key element connecting geopolitics and gold is the role of the US dollar. The global financial system is heavily centered around the dollar, but during geopolitical tensions, currency markets can become extremely volatile. Investors sometimes look for assets that are not directly tied to any single country's currency system. Gold fits that role perfectly because it is a global asset traded everywhere. In many cases, when political tensions escalate, investors simultaneously buy gold and move money into other safe haven assets. This shift in capital can create powerful upward momentum in gold prices. And once momentum begins, It often attracts additional investors who see the trend developing and want to participate. But there is another layer to this story that many people miss. Geopolitical conflicts can also affect commodities, energy markets, and supply chains. When global supply chains are disrupted, inflation can increase rapidly. Rising inflation is another factor that tends to push gold prices higher. So sometimes geopolitical tension affects gold not only through investor fear, but also through real economic consequences. Imagine a scenario where conflict disrupts major oil supply routes or trade channels. Energy prices surge, transportation costs increase, and inflation spreads across the global economy. In such environments, investors often look for assets that historically maintain purchasing power. Once again, gold becomes a natural choice. What makes this even more interesting is how quickly sentiment can change in financial markets. Sometimes, gold begins rising even before major geopolitical events fully develop. Investors who closely monitor global developments often position themselves early. This means gold can start moving on expectations rather than confirmed events. That is why analysts frequently watch geopolitical developments alongside economic indicators. Events such as diplomatic tensions, military buildups, sanctions, trade disputes, or strategic alliances can all influence how investors perceive future risks, and perception alone can move billions of dollars in global markets. Another factor that strengthens gold during geopolitical uncertainty is declining confidence in traditional financial systems. During major global tensions, investors sometimes question the stability of stock markets, currencies, and government debt. When trust in these systems weakens, demand for tangible assets increases. Gold, being physical and globally recognized, benefits from that shift in confidence. Interestingly, this dynamic also creates long-term trends. When geopolitical instability lasts for extended periods, gold can remain in a sustained bull market. Investors begin treating gold not just as a short-term hedge, but as a long-term strategic asset in their portfolios. At the same time, media coverage can amplify gold's movement. Financial headlines about conflict, sanctions, or rising global tension often draw attention to gold markets. As more people hear about gold rising, retail investors begin participating as well. This combination of institutional demand and retail interest can accelerate price movements significantly. However, it is important to understand that gold does not move only because of fear. Sometimes gold rises because geopolitical tensions change global economic policies. Governments may increase defense spending, adjust monetary policies, or introduce financial controls that indirectly affect gold demand. Markets respond to these policy changes as well. Over the years, analysts studying the gold market have noticed a repeating pattern. Periods of relative global stability often coincide with slower gold price movement. But when uncertainty returns to the geopolitical landscape, gold begins attracting attention again. It becomes a financial signal reflecting deeper concerns about global stability. This is one reason why professional investors often watch gold closely as an indicator of global risk sentiment. A sudden surge in gold prices can sometimes signal that investors are becoming nervous about broader geopolitical developments. For long-term investors, understanding this relationship can be extremely valuable. Instead of viewing gold only through the lens of inflation or interest rates, they begin seeing it as part of a larger global puzzle involving politics, economics, and international relations. And this is exactly why discussions like this are important here on the Gold Report. Because understanding the deeper forces behind gold's movement helps investors interpret market signals more clearly. When gold rises sharply during periods of geopolitical tension, it is not just a random price movement. It is the market reacting to global uncertainty. As the world becomes increasingly interconnected, geopolitical events may continue playing a major role in shaping financial markets. Conflicts, alliances, trade policies, and strategic competition between nations will likely remain powerful drivers of global capital flows. And whenever uncertainty rises, gold will probably remain one of the assets investors turn to first. So the next time you see gold prices moving rapidly in the headlines, remember that the story may be bigger than simple supply and demand. It could be reflecting deeper shifts in global power, political tension, and investor psychology across the entire financial system. And now we'd like to hear from you. Do you believe geopolitical tensions will push gold to new record highs in the coming years? Or do you think other factors will dominate the market? Share your thoughts in the comments below, because your perspective helps create deeper discussions here on the Gold Report. If you found this analysis useful, consider sharing this video with others who follow global markets and gold investing. And of course, don't forget to subscribe so you never miss future insights about gold, geopolitics, and the forces shaping the financial world.